Good afternoon, clients, family, and friends. Welcome to part 4 on my series explaining all the new tax provisions from the One Big Beautiful Bill Act. Today I wanted to talk about the changes to 529 college savings plans and explain the initial interpretations of the new Trump accounts. 529 plans are accounts that were initially set up to specifically help parents save for college while retaining ownership of the accounts for their kids. In recent years, these plans have expanded to allow parents to use them for K through 12 education tuition, not just college. The newest modifications allow parents to use these funds for expenses beyond just tuition, and now you can use them for materials, books, tutoring, testing fees, even therapy costs for children with disabilities. It also increases the withdrawal limit from $10,000 per year to $20,000 per year. Now, a new type of savings account for children was created in the One Big Beautiful Bill named Trump accounts. Now, I know the name alone will probably mean 50% of the country won't open these accounts. However, these accounts were actually envisioned by several entrepreneurs who wanted the government to help young people feel vested in the success of American companies from birth. Now, these accounts aim to fill in a gap for savings for children between the plethora of accounts that already exist. We have retirement accounts such as Roth IRAs for tax-free savings, traditional IRAs for pre-tax savings. We have college savings plans such as 529 plans, educational savings accounts, Coverdell plans. Before that, people commonly used UTMA or UGMA savings accounts for their children. We also have created separate savings accounts for healthcare in health savings accounts. We created flexible savings accounts through employers that can help you save tax-free for dependent care or health care with more use it or lose it provisions. And then we also created more plans under the 529 section in the tax code for disabled individuals, and these are ABLE accounts. Now, in theory, this helps children build savings and understand investing in U.S. companies for early childhood expenses such as education or starting a business or buying a home. But in reality, the rules and the restrictions would most likely make these rarely used except for the initial government funding, which we'll talk about on the next slide. The rules and regulations still need to be clarified, and it might be some time until we know the logistics of how these accounts are going to work in the first place, but here are some details. Let's look at the details of who can contribute to these new Trump accounts. How much you can contribute, when you can withdraw the funds, and the tax consequences. So first of all, we can open a Trump account before a child's 8th birthday, starting July 4th of next year, 2026. There's going to be a pilot program where the government actually contributes, where the federal government would automatically open and seed $1,000 for every U.S. citizen born from January 1st to December 31st of 2028. Parents can opt out, and it's unclear how this will work. Now, before the age of 18, there's a maximum family contribution up to $5,000 per year, adjusted for inflation, and that can be made to the account from birth to the year before the child turns 18. No contributions by a family can be made before July 4th of 2026. Now, after a child turns 18, contributions can't exceed the annual IRA contribution limits, which are $7,000 right now. You must have earned compensation up to the contribution amount, or the child must have earned compensation. Potential conversions to Roth might be allowed, but we need more clarification on this. Contributions can be deductible if the individual is not an active participant in a workplace retirement plan. And the investments for contributions after age 18 can be invested in anything, unlike before 18. Now, Employer contributions are also allowed up to $2,500 for teenage employees starting in 2028. No distributions are allowed until age 18, but then after 18, funds can be withdrawn for any reason. Funds can remain in the account until your RMD age, which right now is 75 years old. And after age 18, the Trump account resembles an IRA. The account will have a mix of after-tax and pre-tax contributions, which would be the earnings or growth. You can invest it however you want after 18, and the funds can be withdrawn for any purpose. It's unclear if you'll be able to roll this money over to an IRA or even convert it to a Roth IRA to be tax-free forever. And the contributions are not deductible initially, but the earnings will grow tax-deferred. And the taxation, well, at distribution, the original contribution would be received tax-free, and the earnings would be taxed at ordinary income. And finally, initially, before age 18, you must invest the money in a low-cost mutual fund or exchange-traded fund that tracks the S&P 500 or other U.S. companies. What? That was a lot, wasn't it? All right. I know that was a lot. It's tough to understand and put that in context with all the other retirement accounts that exist or savings accounts that exist. Here's a graphic to summarize some of the rules before a child turns 18 and after. Moving on, in our final installment of this series on the tax provisions of the One Big Beautiful Bill Act, we'll talk about the green energy provisions that currently exist and the credits that are going to expire earlier than anticipated. If you've been considering purchasing an electric vehicle or upgrading your home with solar panels, now might be the best opportunity to take advantage of the tax credits currently available. Until next time, see you soon.